Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Advanced Charting Techniques. And I would suspect there are going to be a number of people watching this webcast right now who feel like they need to be a little bit more responsive to what's going on with the markets. We actually, in our example portfolio right now, have one trade example that's really slow to respond to changing market conditions. So how might a trader speed up their charts to have faster signals in faster markets? That's what we're going to be talking about today. I'm going to work through an example trading system that's designed to be faster. We're going to talk through its pros and cons, a lot to discuss. Before we can get to any of that, though, let me first of all say hello to everybody out there. A lot of familiar names out there in YouTube. Hello there, Life in the Fast Lane, and George, Selva, Speak Truth, Ocean Life, Will, Mary, Greg, Jay Richardson, Chuck, Austin, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you are here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the presentation has been concluded, well, enjoy that show, but be aware that you're invited to join us during the live webcast. This is a Friday webcast series. We kick things off promptly 1 Eastern time. If you'd like to join us, it'd be great to have you here. I also want to let everybody know that my very good friend Mike Fairborn is going to be hanging out there in the chats with us. Mike and I have now been working together for, what, Mike, 20 years almost? Yeah, so Mike brings a wealth of knowledge and experience to this discussion. He's just going to be addressing any questions that I can't get to just during the flow of the presentation. So thanks for having my back there, Mike. And Mike and I would also like to issue an invitation to everybody watching. If you're not following us on X, if you have an account with X, give us a follow. You should be following all your favorite presenters. Best place to connect with your favorite presenters in between these live streams. And you can find Mike there at Mike Fairborn CS. You can find me on X at Cameron May CS. But with that said, let's get into this. And of course, the first thing that we need to do is to consider the risks associated with trading. Certainly applies to what we're going to be doing today. So bear these important disclosures in mind. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including the loss of principal. Okay, so with that said, let's set an agenda for today's discussion. We do have some example positions. We actually have 3 that concluded not so well over the course of last week. It's probably been the roughest week for a webcast that I've done in a long time for the example trades. So we need to go back and learn some lessons from those. So we're going to look at existing positions, look at the ones that have been closed out. Then we're going to look at what's going on with current market conditions, some interesting things that might be happening there on the charts that a trader might be aware of. And then we're going to be talking about speeding up some signals. What we're seeing on the S&P and on the other major indices is we are getting months, maybe a year's worth of movement on those indices within a couple of weeks. So yeah, for some, they may feel like they need to speed things up a bit. So we're going to talk about how that might be accomplished with an example chart strategy. And that is going to be just, it's going to be a combination of maybe a different set of moving averages that you haven't seen displayed before in this specific combination. I think it'll be interesting. Anyway, let's go right to the Thinkorswim desktop. Do some unpleasant revisiting of recent history. We do have 2 positions here. I'm going to come back to those in just a moment. But the first thing that I want to do is look at some positions that have closed out. We have our MPC trade on ABV is current. Let's look at our PM, AON, and Netflix. So starting with Philip Morris, what did it do to us? Let's come here. Actually, yeah, let's do that. Let's go to Philip Morris. Actually, you know what? Nope. I'm going to do this in this order. I think it's just going to help the flow of things. Let's have a look at that MPC position. I'm going to come back to ABBV. That's the kind of culprit here that I want to talk about speeding things up a little bit. So let's start with MPC. So our MPC position, this is last week's trade. You can see that we have a limit order up here, a target price. We have a stop down below, and it's kind of been waffling around right within that range. Just to revisit the logic of this position, We can go back up here to our studies. Let's load up our MPC study set, which was our linear regression study set. We talked about last week the fact that we had come down to the 50 linear regression, which has been a pretty decent reversal point for really almost the entirety of the last 12 months. And anticipating that we might be rising off of those levels, we took an entry right here. So that was the 4th. We did place a stop in case the stock decided to continue going down, and it did. It kind of teased down toward that stop level, didn't quite get down there, popped up on some high volatility, almost got up to our target. Now it's kind of been sagging back a little bit, but that one's just sort of waffling around right within our planned trading range. We'll let it continue to work. Let's look at some of our closed positions here, starting with Philip Morris. This is one where we had done some measured move trading after a technical signal. Let's load up our signal. Now, by the way, before I move on, let's load up our Philip Morris study set here. So that was our Chaikin money flow trade. But if you missed these trades, I can forgive you. You can't watch every single one of my webcasts. Maybe you can. But in any case, if you ever need to go back, if you're intrigued by a set of studies or by maybe a webcast that I mentioned, you can always go back and rewatch those webcasts if they've been archived to our YouTube channel. Make sure that you do yourself this favor. Subscribe to our YouTube channel. You can go right down below the video stream right now. Click on the subscribe button. It literally only takes a second. It doesn't cost anything. But our YouTube channel is where we house previous webcasts. Yes, you can join the live streams here as well. But once you've subscribed, you can go right to YouTube and just look for Trader Talks Schwab Coaching Webcasts. Go to the home page here, and this is where you can find the playlists of our previous webcasts. So for example, this is the Advanced Charting Techniques webcast series. We have a lot of webcast series. Mine happens to be, if you scroll down a bit, it's right there in the middle, just a little bit to the left. I'm going to click on View Full Playlist. And this is where we can go back and see these previous studies that we've learned about. For example, the one that we were about to look at, we reviewed in our Guide to Trading the Chaikin Money Flow indicator. So yeah, make sure that you're subscribed to the channel. But back to our trade here, what we noted here was that our Chaikin Money Flow had dropped just slightly below that signal line and then crossed back up above it. And that's commonly seen as potential entry points. And what we were hoping for was maybe a repeat of what we saw the previous time, crossover, signaling a nice run to the upside. And John says, yeah, Chaikin money flow trade. John, yep, you'll want to go back and watch that archive. That'll get you up to speed on this. But we got a crossover signal right here. This was on the 26th. So we took our trade right there. And we were looking to see maybe an advance that was roughly equivalent to previous advances. So we set a target right up here, almost got there. So we had a 165 target. We actually got up to 162, and then the stock betrayed us. This happens. It's just trading at times. Still had our stop in place. Price fell back from that level and then triggered that stop. Now there's always a lesson in trading, whether there's a profit or a loss at the end of the trade. Trader can go back and just learn from this. Maybe for some traders, they might say, well, if I get within a certain dollar amount of my target, or if I made a certain percentage toward that target, it may be a signal to start moving that stop up. So maybe on the retracement, we might not have given back so much of the profits and even fallen into loss territory. All of those things are adjustments that might be made in a trader's own investing plan. But that trade's done. So let's have a look at that other position that we're currently in. So this is our AbbVie trade. We're currently in it. We still own 25 shares, and those shares are not treating us well. And it's because this system isn't designed for quick entries and quick exits. It's designed for capturing longer moves, and there can be significant ebbs and flows within those moves. And we got an exaggerated example of just that in this trade. So if we go back to our chart, here's ABV. Let's load up our studies that we use to plan this trade. So I'm going to load our ABBV study set. And for this one, we're using a ribbon study. And in this case, the specific entry was to look for these lines are all assigned numbers. Ribbon study 1, ribbon study 2, ribbon study 3. Some are faster, some are slower. But what we noted here in a typical entry was our RS1, that's our thickest line, was crossing up and above our RS2, which is next thickest. It also happens to be the next fastest. Now, even though, oh, and by the way, as we discuss this entry here, I want to hit the pause button for just a moment and say we have some special guests that have just chatted in. I caught you there. Thanks for letting me know, Ben. We just had, a few hundred friends join us from the Detroit Technical Analysis and Option Strategies live workshop. So hello there, Detroit. Give them a shout out for those of you that were already in the webcast. Chat in, say hello to our friends in Detroit. I have a little message for those of you who are there with Ben. You guys have some fabulous instructors with you right now. Ben and I have worked together for 20 years. He's a great instructor. Ray and Scott and I are also very good friends. I've worked with Ray and Scott. They bring a lot of knowledge to the discussion that you're having there on technical analysis and options. And I also understand you have Kevin Horner hanging out there in the back. I know that he's not here helping us out. So Kevin Horner is a great support to have there, supporting the whole thing. So I hope you all enjoy that workshop. But today, in my webcast, let's get back to business. We're talking about charting. And specifically, we're talking about how can we maybe speed things up? Because here's this study that I have on the chart right now, kind of slow. So this was an entry right back here on the crossover of the RS1 over the RS2. There was our entry. And you might think, well, stock has come back so far, surely there's been an exit signal. Nope. A typical exit for this might be when the RS1 crosses back down over the RS2. It's not even close to doing that. This is a study that's intended to capture longer moves and ride out the waves. Now, we don't always get such a dramatic move to the downside, but this stock has a demonstrated history of having just that at times. So yeah, this one got me thinking, let's talk about maybe a faster set of studies in today's discussion. So, oh good, Felton, you're saying the Detroit workshop is awesome so far. I don't doubt that in the slightest, Felton. Yeah, hope you're all enjoying it. And by the way, as a reminder for everybody watching, best place to connect with your favorite presenters in between these live streams is to follow us on X. So if you want to track me down, you can find me at Cameron May CS. Best place to find me if I'm not live streaming at the moment. You can also find Mike Fairborn, who's helping out in the chats, at Mike Fairborn CS. All right, but let's go back we have a couple of final trades that we need to review, and then we'll get to the markets and talk about maybe speeding things up a bit. So this is an existing position, still an existing position, set the stage for today's discussion. But let's go on to two other trades that have concluded, and man, these were teasers. We had AON, just concluded over the week. So let's load up our set of studies here. Our AON trade was actually a Bollinger Band trade. So what we noted with AON is that we had just gone into a squeeze. Our upper band starting to narrow, our lower band starting to narrow, but also we pulled down and touched off that lower band. And when we got that white candle off the lower band, that was the entry with an intended target if we get right up to the upper band. Now in this case, it's another one of those that just came up short. We didn't quite get there. And then we peeled away and came back down. And in this case, we had a stop just down below our entry, and that stop was triggered right here. So the AON trade is concluded. With each of these trades, you can just go back and rewatch the archives. But these volatile markets, yep, it happens. Sometimes we just get stopped out. We have one more, and that is Netflix. Now, Netflix, we actually used our trend value momentum study set. So let's come up to our studies. Let's load up that study set. Trend, value, momentum. In this case, our trader is looking for a confluence of 3 technical variables. First, they might check that the trend is bullish for a bullish trade. And the specific confirmation here is we use a 50-period triangular moving average. And as a teaser, as a spoiler alert, this is going to come back into our discussion later. This is going to be an element of our new trading approach. All right? But in this case, we're using a combination of a 50-period triangular moving average set against a 100-period triangular moving average. So one that's kind of intermediate term, the other one that's a little bit longer term. And the trader, to confirm trend using this combination, might be just looking to see, is the 50 remaining above the 100? And right here on our date of entry, we noticed that was the case, 50 solidly above the 100. At that same time, we also noticed, let's just put a check next to bullish trend. We noticed that the RSI, which some traders might use as a short-term indication of value, the RSI had slipped down below the 40 line and had just started to rise back up. And for some, particularly in bullish market conditions, in a bullish trend, getting really deep on the RSI is pretty uncommon. So a more shallow drop may still signal the presence of a short-term value if prices are at short-term lows and maybe set to rise. In this case, we got down below that 40 line and started to rise. So we had trend, check. A potential indication of value, check. And then finally, our momentum oscillator, TVM, trend, value, momentum. Our momentum oscillator, our MACD, had dipped low to a bright red, and those histogram bars had shifted to a dark red. To some traders, that might signal that price momentum has been bearish, but is just showing the initial signs of a return to bullishness. And so there we are. There's our TVM entry, and we got our confluence of all signals right there. Took the entry on the 14th of March. And initially, the trade was going well, but then it started to struggle with the rest of the markets, came down and actually hit our stop. So we're stopped out of that. Unfortunately, we've seen a recovery. Can anybody else relate to that? Does this happen sometimes in a very choppy market? Get stopped out, we're left abandoned on the curb while the rest of the markets take off again. And this is where the trader might need to assess, are these markets that I'm comfortable rejoining? And in this case, we're going to, so that we can have continued example trades, but that's a good question. So let's go gauge market conditions. And what we're going to do here, now that we've reviewed 3 closed trades, we've reviewed our 2 active trades, let's go see what's going on with the markets. And we're going to use this same lens. One thing that I do to give some continuity to these discussions is that I stay with this TVM view of the markets, this trend, value, momentum set of technical indicators each week. That's not to say that this is the best set of indicators that one could possibly use. Not at all. It's always for educational purposes. But yeah, I don't like the webcast series to be too entirely disjointed as we're exploring all sorts of different tools. So this is our common thread. All right. So let's have a look at the S&P 500. And through this lens, there's something interesting that happened just recently. I'm going to come down here. I just created a drawing set before the webcast started. Throw some arrows on here. So what's been going on? Well, very recently, the 50-period triangular moving average crossed down through the 100. If you don't know what a triangular moving average is, I'll explain it in a little better detail in just a moment. I have discussed it in good detail in previous webcasts, so you can go check out the archives for that. Especially look for moving average as a keyword. Anyway, the 50 crossed down through the 100. So for the trend, the bulls might have said, wait a second, this doesn't look as good. Julia says you can't find me on X. It's at Cameron May CS. The CS is for Charles Schwab. Okay. Now, a second thing happened right down here. So there's trend. What's happening with our value indicator? Well, it was it was attempting to rise, but then it turned downward. That's a second, wait, pump the brakes. And then also on our momentum oscillator, it had been rising. We did have bright green. It transitioned to dark green. That might be an early sign that momentum was stalling out. And you can see right there is when we got the third signal from our TVM that we might be set for some bumps in the road. And that's just what we've had since then. It has been if bumpy is what we were looking for, yeah, that's what we have. Now, going more currently though, let's throw a couple more arrows on here. Maybe this will be slightly more encouraging. We did pop back up out of that 40 oversold area. Maybe there's some value in the markets again. We also got our MACD oscillator turned the right direction. We're still solidly, that 50 still below the 100. So for a purist using this combination of technical indicators might say, I'm waiting. But waiting can cause missed opportunity if the markets move in the direction that we suspect. So let's take a look at this now through a different technical lens. I did something in a webcast just yesterday. I thought I'd revisit it today. I'm going to use some Fibonacci analysis. I'm not going to get fancy with Fibonacci's. I'm just going to use them as a convenient tool to make a little observation here. Let's clean off our drawing tools here. Let's switch our drawing set back to just the default. There we go. And I'm going to come up to our studies and just remove all the studies. There we go. But what I wanted to discuss was the proportions of the moves that we've been seeing, as dramatic as they've been over time and over shorter time frames. So let's look at the 3-week chart. And if you saw this yesterday, it's kind of interesting. It's not a guarantee of where we're moving from here, but we had this great run from this October. So this is a weekly low, the week of the 10th of October of 2022. Hit a low and then started to rise and rise relatively rapidly over time up to this peak where we topped out the week of February 17th, or specifically February 19th. The S&P hit its peak. And then we had this dramatic sell-off. Well, what's been the distance or the proportion of that sell-off? Well, for traders who look for strong moves in one direction or the other, in order to gauge how far a pull back against that move might be, a common assumption is we might typically give back somewhere in the neighborhood of 50%. So I'm going to go to the top of this. I'm going to use my Fibonacci drawing tools. John says, can you show this also with moving averages? I'm going to restrict it just to this Fibonacci lens for just a moment. John, I'll bring moving averages back into the discussion in a moment. But let me click up there at the top. I'm going to move all the way down here to the bottom and click again. And where did not yesterday's candle, this is the weekly candle, stretch down to? Yeah, over the course of this week, we actually reached all the way down, gave back 50% of all of that gain from those 2022 lows. And for some traders, they actually may see this as a bullish sign. We've surrendered the distance that might be otherwise expected, and now we're starting to rally, not just a little bit, but fairly sharply off that low. So that's kind of interesting. So let's remove that drawing and go to our shorter term chart. Let's go back to this weekly chart. And here's that 50% retracement, and it carries its own interesting proportions. Let's use this same drawing tool, and I'm going to go to the bottom here and go back to the top. So this is the 50% retracement of that multi-year advance that we've made. And on this rally, how high have we stretched in our attempt to recover from that sell-off? Right at 50%. Well, that's very interesting. That's actually just what a Fibonacci trader might expect. So we've looked at things over a multi-year chart. We looked at a multi-month chart now. Now let's look at just this last week. So we have one that might be an indication of, oh, good, bullish, we've hit a bottom. Oops, now we have resistance, we might be up at the top. Well, let's get closer, let's get faster, and let's look at this last week. I want to zoom in here. and we've had this rally, and then its own little sell-off. So if I go to the top of this rally, come down to the bottom, so when we're looking at rallies, typically draw from the top down. When we look at sell-offs, we typically draw from the bottom up. We hit this peak, and within the next trading session, drove right on down to a little bit beyond a 50% sell-off, and then started a recovery again. So we have sort of long-term potential bullishness, short, let's say intermediate bearishness, and now maybe we're starting to strengthen again. Let's say that our trader looks at all this technical evidence and they think maybe in the short term we could continue this rally, possibly back up to these highs, potentially further, but they want to be responsive to changes in the markets, and using something like that ribbon study may not get it accomplished. We've already seen that. So how might we speed things up? I want to bring up an example chart. Let's clear off this drawing. And I want to switch over here now to, how about we look at Pepsi? So here's a chart of Pepsi. And let me clear off some of these drawings here. There we go. Just start with a nice clean chart. And I want to talk about, speeding up the signal. So the first thing that the trader might do is, if they've been in the habit, and maybe they're still paying very close attention to what's going on over years and over months, well, maybe if we want to be more responsive, the first thing that we might do is shift to just looking at weeks and days. Now, I'm going to be talking about trades here that they may be started and concluded within a few days. So this is not always for every trader's approach. But what I do like to explore in this webcast series is a range of approaches. It's never my intended purpose to say this is the way to do it. Nope, it's just to give everybody a more robust tool set that they can draw from as they make decisions for the potential management of their own self-directed portfolios. So I am gonna speed up our view by looking at a shorter term time frame. Now, on this time frame, what I might note though is that we've been kind of chopping back and forth. We've kind of been trading down toward the lows of recent days, and possibly set to go higher. Just with that as a backdrop, let's go to a faster time frame. I'm going to use one of our default time frames here for the rest of our discussion, or at least for the majority of the rest of our discussion. I'm going to switch to a 20-day hourly chart. Now, as I do that, if you haven't ever looked at one of these shorter term charts, they can get kind of cluttery. That's because we're seeing new time frames that maybe we're not used to seeing. And those are highlighted in the gray area here. That's actually the aftermarket trading. You're going to see lots of gaps. That's going to be very typical of the aftermarket trading because it tends to be thinner, particularly on these individual securities. The wide areas are actually the normal market hours. Now, I actually am not going to be doing any trading examples in the aftermarket for this discussion. So to avoid generating trade signals in the aftermarket hours that we wouldn't necessarily be acting on anyway, let's come up here and make one adjustment to our chart. I'm going to click on our chart settings, go to equities, because we're trading stocks right now as examples. And where it says show the extended hours trading session, I'm going to uncheck that box. We just don't need it for this approach that I'm going to be talking about. So as I click apply, all the gray area is just going to be snipped out of the chart, and the normal trading hours are going to be stitched together just like a normal weekly chart or a daily chart that we're already used to seeing. It's just that now we're looking at it on an hourly view. So all of these now are the normal trading hours. And now we're prepared to start to apply our faster technical studies. And as I mentioned, we're going to be using a combination of moving averages. So the first thing I'll do, let's get a moving average on here that I've already used early in the webcast, but not everybody's familiar with it. Let's come up and I'm going to add, using our edit studies icon, a triangular moving average. So we can type in moving average triangular, or just type in tri as a keyword. And let's select a moving average triangular and add that to our charts. And just like with the rest of our moving averages, it's going to default to a 9. So on an hourly chart, this would only be looking at the last 9 hours to generate our moving average. I'm going to change that and lengthen it a little bit. Now, there's a specific reason why I'm choosing to use a triangular moving average, even though we've moved to a shorter term time frame, and our intent here is to speed up the generation of signals. If we go too fast, the trader may generate a really choppy view of the markets. And so, for example, if we were to use like an exponential moving average, which in the field of moving averages is among the fastest, that can be maybe a little bit too responsive for some traders. It might generate a very jagged look on the chart and maybe give a lot of whipsaw events. So I'm going to slow this down with a triangular moving average. Let's click OK and click Apply. And I want to talk about what this moving average is for a moment. The first thing that we'll see is it has a very smooth, look at that reassuring, it's like a whole milk. It's just smooth, right? This is actually, if you're not familiar with a triangular moving average, it's also known as a double smoothed moving average. It starts life as a simple moving average. And we know that with a simple moving average, if we were looking at a 20-day, since we're looking at a 20 triangular moving average, let's stick with 20. If we were looking at a 20-day or a 20-hour simple moving average, well, we just take the closing values over that period, looking over the last 20 periods, 20 days or 20 hours. We get an average and we plot that on the chart, and then we just change that for each subsequent hour or each subsequent day. That creates our simple moving average. Well, a triangular moving average just goes one step further. Instead of using closing values, it uses the simple moving average value for each period. So, if we have a day where Pepsi closed at 144, but if its simple moving average was at 143, it just uses 143. If then Pepsi drops down to 142 and closes, but the simple moving average is still, 142.90, it uses 142.90. So it uses a smoother version. So that's how we get this effect, a double smoothed moving average. Now, the intended benefit here, even on a shorter term time frame, is that it's not going to be so quick and so jagged in changing direction. And it's also, for the purposes of this trading strategy we're going to discuss, it's not the signal. The signal is going to come from a faster moving average. Now we're going to speed things up. Let's add another moving average. I'm going to go up to our little Edit Studies icon, and let's add an exponential. So we're going from one extreme of moving averages to the other. So we're going from a smooth moving average to an intentionally fast moving average. So let's choose our moving average exponential. Let's add that to our chart. And in contrast to our 20-period moving average, let's choose a 5. Now, what we're going to be doing here is creating what's called a crossover system using a longer term moving average. Notice neither one of these is anywhere close to a truly long term. So we just have longer and shorter. In this case, we have a longer moving average, which is going to be our triangular moving average, this sort of smooth line. And then we're going to have a much shorter exponential moving average. And it's going to be the interaction between those two. If our short-term accelerated trend interpretation crosses up through that longer-term, smoother, that may be a signal that things are changing. And the trader might want to change with it. So I'm going to click OK. 20 triangular, 5 exponential. Let's click Apply and click OK. And here's what we're left with. A lot of you are familiar with crossover systems. This is just it's a variation on that theme, but intended for shorter term approaches. Let's go back over this last 20-day period. This is not, we're not looking at weeks, we're not looking at days, we're looking at hour by hour. And let's look for signals. And I'm just going to use my arrows here again. And we got our first signal right there as the 5-period exponential moving average rose up and through the 20. Now, with any combination of moving averages, it's going to be quite common to see what we call whipsaw events. For those who have never traded a crossover system, what we're looking for is the shorter term moving average, the faster one, represented here by our exponential, to cross up and through the longer moving average. That's our green triangular moving average. When the faster crosses up and through the longer, that generates bullish entry signals. If it crosses down through the longer, that generates bullish exit signals or potentially bearish entry signals, and so on. All right. Ted says, can we change the color thickness? Yeah, we can do that, Ted. I think that's not a bad idea at all. We can come back here. Let's change this. How about we change it to 5s? 5 out of 5 for thickness. Just make it easier for everybody to see. In any case, there's our crossover here. And when we're crossing the shorter up over the longer, that can generate an entry signal. Notice how quickly this generated an exit signal. So initial signal came on a Friday, exit signal came on a Tuesday. Is this faster signals? Yes. Now, I got to emphasize, faster does not always immediately translate into higher quality. Sometimes it just means we take faster losses. That's a possibility. But a trader here may have taken a bullish entry here and closed that here. Now, at the same time, a bearish trader may have applied some bearish approach here, looking for an exit. It looks like we may have gotten a crossover right. I might have to zoom in a little bit here. Yep, there's a whipsaw right there. There's a bearish exit and a bullish entry right there, and then a bullish exit and a bearish entry right there, and then right back again. Yep, this can give quick signals. So how might the trader adjust for these intraday whipsaws? Well, they might introduce a rule like, hey, I'm only going to do one trade. If I get an entry, I'm in until the next day at the earliest. If I get an exit, I'm not re-entering until the next day at the earliest. That might assist with these intraday, hour by hour whipsaws. All right, so there was another example right there. So in any case, let's say our trader has our bullish entry here. There's a whipsaw right there. So they might just be out. And then they might just be waiting for the next bullish entry, which might have come right here. But in any case, what we're really just looking for here are the crossover signals to tell us to get in or get out. I think this is a very realistic example of how this sort of approach typically plays out. Very commonly, we'll have a little series of small gain, small loss, small gain, small loss. But these tend to do a pretty good job of having the trader on the right side of a trade when a stock starts to move more dramatically in one direction or the other, when it kind of makes up its mind. So this is interesting. It looks like we might be priming for a possible entry right there. Let's have a look at one more stock and maybe plan and place a trade here. I want to look at Amgen. And I'm going to back off here for just a moment. Let's have a look at the longer term view for Amgen. And even longer than this, because even though we're doing a quicker set of signals, that doesn't necessarily mean the trader is always, they always have their blinders on regarding what's going on a longer term time frame. I think it can still be interesting to would-be Amgen traders that this sell-off that we've had from these peaks, that 330 area has been a pretty solid resistance, getting up sometimes to 340. We've sold off this week down to lows that have been a pretty good support for not just a day or two or a week or two or a month or two, but we're talking about a couple of years where we didn't get much lower than we got earlier this week. And now we're starting to rally. So getting that longer term perspective may actually help the trader tilt the scales regarding which way they want to take this shorter term approach. And maybe our trader thinks that this rally off these lows is likely to continue, so they're planning on maybe just doing bullish trades. So let's go back here to our 20-day, 1-hour chart, and we notice we're just getting that crossover. Is it a guaranteed success? Of course it's not. But if Amgen ultimately decides to rise from here, we'll see how high it can go before we get that offsetting crossover. So I'm going to put a line or an oval around today's. There we go. That 1 hour candle. And we're going to take a trade. Let's go place our trade on Amgen. In this webcast series, we typically invest about $5,000 in each trade. This is a $286 stock. 10 shares would be 2,800-ish. Let's do 20 shares. So I'm going to go to the ask price. Let's click on that ask price. And let's just dial this down. I'll just erase the 10. Let's put in a 2 for buying 20 shares of Amgen. And markets are open. I'm going to do this. This always, this can cause the blood pressure to rise a little bit. I'm going to put in a market order. Obviously, that comes with risks. We're going to discuss that right now. We're going to put in an order to buy 20 shares of Amgen at the market price. And with market orders, prices can change quickly in fast market conditions. We're talking about being quick. We're trying to be the quickest getting in. That's a risk. Right now it says 286.67. We know prices can change rapidly, so that can result in execution prices that can be different from the quotes displayed at order entry. So let me just send that order off. Now there's not a commission on this trade. There can be on some types of trades. Let's send that off. And we are now in Amgen with the plan. And if it's helpful, we can go back here to our chart and just make a little text note here. Sell on bearish crossover. There we go. And I'm going to come up here and save that as a style. That's our Amgen 20 triangular moving average and 5 exponential moving average. Let's save that. Oh, actually, I intended to do this. This is a nifty little trick. If we go to save style again, we just want to check the box here that says include patterns and our study set. There we go. And guys, there we have it. Oh, Julia says you just noticed you haven't heard of a walk order. That we have some videos out. You maybe just go to our channel, type in walk order. Yeah, that's a new feature. It was just introduced just in the last couple of weeks. But we've accomplished what we set out to do today. Markets are choppy. I wanted to talk about what might be a system for speeding up entry and exit signals on a chart. So we've learned about triangular moving averages and how they might be used in combination with an exponential moving average to generate faster trade signals. We'll see how this one plays out. But we also had a look at our existing positions and took another peek at the markets through a couple of different technical lenses. It's always fun to do that. This is what we do on Friday afternoons. So I would hope that you put it in your calendar. Actually, I can't say afternoon for everybody in the continental U.S. because it's not even afternoon yet here in the mountains of Utah. But in any case, yeah, 1 o'clock Eastern is when we kick off this webcast series if you want to join us. But I'm going to let you go. But as you go, just remember that you have some other resources available to you. Number one, make sure that if you haven't subscribed to our channel yet, go down below the webcast right now, click on the subscribe button. It only takes a second. It doesn't cost anything. But our channel is where we house our playlists, and you can also join the live streams here. Also, make sure that you're following us on X. You can follow Mike Fairborn at Mike Fairborn CS. You can follow me there at Cameron May CS. Somebody was asking me earlier, what is my handle? You want to be precise with this. You want to make sure that you find the right person because there can be similar handles on social media at Cameron May CS. But this is where I can post things when I don't have a live stream going on, and if you reply to one of my posts, I try to reply right back to you. But everybody, thanks to everybody who's already given a thumbs up on this presentation. I can see there were nearly 200 people watching this live stream, 61 thumbs up already. That's awesome. Thank you for doing that. That always sounds like applause to me, and it also gives my webcast a boost in the YouTube algorithm so that more people can find and learn they can find my webcast, they can learn these sorts of things like maybe potentially speeding up trade signals. All right, everybody, I will see you next Friday. Thanks, Mike, for helping out in chats. I'll look for you in my other webcasts, everybody. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.